Today we're going to talk about some strategies that are important to understand for multiple borrowers. And there are some really important strategies to be aware of that can significantly affect your cost of money. Because if you just go online and you just enter in your data and they ask you how many borrowers, they're just going to assume that you're going to both be on the loan and they won't think through any of these things. And you may end up paying a lot more than you otherwise would have to. So what are those some of those strategies? What are those situations or circumstances that would dictate this? So the first of all is just a typical case. Let's just start with the typical case. You have, let's call it husband and wife, two borrowers. They're buying together, and the typical case is they're both going to be on the loan and they're both going to be entitled. Okay, that's the normal. Nothing that I'm about to say here is going to suggest that the majority of the time that you would have it otherwise. But a not insignificant portion of the time, you will have situations where you really want to think through whether or not you should structure things a little bit differently. Let's talk about the first case. A very common case is you have a husband and wife, and they have one of them has good credit, one of them has bad credit, or one of them has really good credit, one of them has so-so credit. And so if you can qualify with just the good credit borrower's income, then it may be very much worth your while to leave the person who doesn't have the good credit off the loan. And they can still be entitled. It doesn't mean that they're not an owner of the property. They can still be entitled, but they don't have to be on the loan. And just to illustrate that, if I took a $750,000 purchase with 10% down, very kind of common transaction, in my market over here, if you have someone that has 740 credit, then, or a couple, let's say, both borrowers have 740 credit or above, today that pricing would be 6.583 would be the note rate. And the mortgage insurance cost would be $118 per month. Now, if instead you took that same couple and you said, now one of the parties has 680 credit. So you have one with 740, one with 680. It's always the lower credit that's going to dictate the pricing on the loan. And so now, at 6.583, instead of paying 0 points, you're going to pay $6,250 in points in order to get that same rate. And that's because you have lower credit. And in addition, the additional cost doesn't stop there. Then your mortgage insurance goes from $118 a month to $253 a month, a very substantial increase. So you can see that it makes a lot of sense to make sure that you're evaluating the relative credit scores of the two parties before making the decision about who goes on the loan, and at least making that decision aware of what the costs are and what the possibilities are. Now that only works in that situation where the party with the good credit can qualify on their own. Their income qualifies them on their own. They don't need the other party to qualify. Now let's look at a different situation where you're going to want to have the person with the bad credit on your loan. And this is typically a situation, let's say you have a first-time home buyer. Now, first-time home buyer programs, there are a number of programs out there. Some are meant to address the down payment problem, and they tend to be costly. They're expensive money, but they do address the down payment problem if you have zero down payment. But more likely, what Fannie and Freddie are both doing right now are improving your pricing if you're a first-time home buyer in many situations. And so in that situation, Fannie and Freddie have both come out and said, look, we want to help first-time home buyers, and we want to help them in a way that if you're a first-time home buyer and your income's not quite over certain limits, then we're going to ignore your credit score. At least we're going to ignore the typical price adjustments that we would make to your loan if you have a poor credit score because you're a first-time home buyer. Now, in that case, your first-time home buyer pricing is going to be just the same or even better with the person with poor credit on the loan, because they're going to ignore the poor credit. If the person with the better credit isn't a first-time home buyer, then you wouldn't get that advantaged pricing, because even though they've got good credit, they're not a first-time home buyer, and so they don't qualify for those special pricing. So in that case, even though the person who is the first-time home buyer has poor credit, you'd still include them on the loan, because the benefits that Fannie and Freddie right now are both giving to first-time home buyer programs are typically going to outweigh any negative impacts associated with your credit. And remember, most first-time homebuyer programs only require one of the borrowers to be a first-time homebuyer. So that means one of the borrowers doesn't have to be. They can have owned multiple homes. As long as one of the parties is a first-time homebuyer, then you're typically eligible for those programs. So that's a situation where you would want to have the person with bad credit on the loan. Now, what about the situation, this is probably the one that's the most counterintuitive, is what about the situation where you want the person with good credit off of the loan? And we do have those as well sometimes, and that's because many of these first-time homebuyer programs are income limited. So if you make too much money, you don't qualify for the special pricing. And so I have had situations where the person with the good credit is kicking us over the limit, and the person with the bad credit can qualify. They have enough income to qualify on their own. So we'll keep the person with the good credit off of the loan because they put our total income for the file over the limits for that special program. And by keeping them off the loan, our income is below the limits and we're eligible for that special pricing. So those are just some of the strategies to keep in mind when you're considering, when you have multiple parties on the loan. Don't just assume that everybody should be on the loan, but don't even just assume that someone with bad credit may need to be excluded from the loan. There are different circumstances, and it's just really important that you talk to a mortgage professional about your specific situation and make sure you optimize pricing. Thanks so much.